On that, Mike was going to hopefully tell us that in the 50 years, developing economic thinking has improved.
Yes, wouldn't that be good? Thank you, John. Thank you, Peter, for that excellent introduction. And there's much to admire about that, and much to agree with, I think, especially about things like structural reform. Why do we have a corporation tax? I wasn't going to really address that here, but you've already kind of made the point. I think, but part of the reason for taking this kind of 50-year view is to say, actually, it doesn't have to be like this. It actually was different in 1965, and it could be different in 50 years' time. We don't have to take the kind of existing structure as given, and we can think of more fundamental reforms. And we're both academics, so we both like thinking about those kind of things. But I think it would be useful to think more broadly about those kind of things. And one other kind of point by introduction, I'm an economist. I think there's a nice complementarity between economics and law here. In our centre, we do both economics and law research, and I'm going to talk more about some economic issues. But it's going to be a kind of strange history, kind of delving about. I'm going to do it more by kind of thinking about different kinds of topics, and then think about what's happened over that time. But also about the development of economic thinking over that time, because I think we've all developed in the ways that we think about corporation tax. Certainly, I started in thinking about these things when I was working in the Institute for Fiscal Studies. I joined there in 1982, which was just after soon after the Mead Committee had reported, and that was the kind of received wisdom that we young people were given at the time. Things have changed since then, and I hope to take you through some of the ways that certainly my own thinking has developed since then, in the context of these four topics. So first of all, relationship with personal taxes; second, tax rate and tax base; financial instruments; and then international aspects. So that's the plan. Personal taxes. So Peter's mentioned this quite a lot already. I'd like to suggest that actually at the moment, certainly for large companies, there's a kind of triple taxation. There's potential triple taxation, or at least there has been at different times. Certainly, corporations, companies earn some profit, they pay corporation tax. If they pay that out as a dividend, then the shareholders face dividend taxes as well. It's common to think about that as double taxation, to think that if the companies didn't pay out a dividend, the value of the company would go up, shareholders could sell their shares and make a capital gain, and then they'd be taxed in capital gains instead. But actually, if you think about, at what price would somebody be willing to buy those shares from you, or indeed at what price are you willing to sell, then we might expect those dividend taxes to affect that price. And if somebody offers you some financial instrument which is going to pay you £100 before tax, but £75 after tax, how much would you be willing to pay for it? Are you going to be willing to pay £100 for something which is only worth £75 to you? The answer is probably no. So we can probably imagine that share prices ought to reflect dividend taxation that's going to be due on that income which is going to be flowing out of corporations. And if so, there's a kind of level of tax which has already been paid. The price at which people are going to be willing to pay that is going to reflect the future dividend taxes that will be paid on that future income. In which case, there's no real need for capital gains tax as well on that income. And if there is, that's a kind of triple taxation. So that immediately raises questions of what it is that we're trying to do in taxing certainly large companies, but probably smaller companies as well. The other big question there is, in thinking about the impact of taxes on business behaviour, whose tax rate is going to be relevant here? And I'm going to come back to that in just a moment. So let me think. So I'm going to give you some economic theory here, so apologies, but it's going to be straightforward, but I hope incisive and illustrative. So first of all, let's think about investors. What do investors do? You have some money, you'd like to save that. What can you do? There are lots of different forms of saving that you can use. You can put your money into housing, into your pension, you can put it in the bank, you can buy shares, you could put it into some intermediary which will buy shares for you. In principle, what individuals should be doing is to try and, you'd like to equalise the rates of return you get from those kind of different investments after tax. If you can actually increase your wealth by taking money out of the bank and buying shares or vice versa, then that would be worth doing. So in principle, the way that we think about that is to say that investors are probably going to equalise post-tax rates of return. Now, in a closed economy, which is, let's go back to 1965 or the early 70s. People were really thinking in kind of closed economy terms. We've just had an academic conference here and for the last few days. So we also have, I think there are pockets of people who still think in terms of a closed economy, but they mostly come from the US, which is a much larger economy and actually much more closed in a sense than the UK and other European countries. But when we think about closed economy, all those tax rates, the tax rates on dividends, capital gains, corporation tax rates, they're all going to affect the rate of return that anyone is going to earn from investing in shares. And those are all therefore going to affect the allocation of shares, they're going to affect the required rate of return on corporate investment. And that was all the source of much study in the 1970s and onwards. In particular, I mentioned this by Mervyn King wrote a note in the Green Paper, Corporation Tax in 1971, setting out the kind of basic way in which it would work, and we're still using that analysis today. I even use the same terms, that M stands for personal income tax rate and Z stands for capital gains tax rate. So we're indebted to Mervyn King, who's clearly gone on to greater things since then. But that's the kind of closed economy setting. Now I wanted to say something about, let's move straight to an open economy setting. So we kind of shift forward 50 years. What difference does that make? Well, actually, I think it makes an enormous difference because this is my picture of the world, more or less. And basically, there's a world capital market. So if you want to save your income, you want to savings, what rate of return will you get? Well, you won't be kind of investing just in the UK. You put your money into a bank or into a financial intermediary. That will be invested in world markets. And everybody else in the world is doing likewise. So there is some kind of world capital market there. UK companies, the rate of borrowing of UK companies is going to depend on what they can borrow from the bank, but they're connected to the world capital market. Or if they're issuing shares, then the price is going to depend on the rate of return in the world markets. So there's we've got a kind of divorce between companies at the one side who are kind of trying to take funds from the world market and savers on the other hand who are putting funds into the world market. Now, then we need to think about taxes in those two contexts, because what we have typically is companies face a source-based corporation tax depending on where they're doing that activity. By and large, individuals are facing a worldwide residence tax on their income. So the way that would kind of naturally work in this context is that you receive some income from the world market, you pay tax on that, and your post-tax rate of return is reduced. On the other hand, UK companies are going to have to pay that world rate of return after corporation tax, and so corporation tax is going to push up their pre-tax required rate of return. That kind of divorces the pre-tax required rate of return of UK companies from the post-tax rate of return of UK individuals. And that really kind of drives a wedge between what we're thinking about individual taxation and individual savings decisions and corporate taxation and company investment. What does that mean? Well, okay, we're now left, when we think about distortions of savings behaviour, that primarily depends on how individuals are taxed on different forms of savings. So if you're taxed on one form of savings at a higher rate than another, that's going to distort your savings choices. But no, this is going to be this is a kind of pre-tax rate of return from world markets. That's not really going to affect UK companies. So there are certainly issues of how we tax individuals here, and there are certainly issues for small companies, which Judith Friedman is going to be addressing later on. But when we're thinking about corporate investment, certainly for companies that are kind of widely held and can be owned by individuals from around the world, we're in a different position. Those have to earn the pre-tax rate of return so that after paying corporation tax, they can kind of pay the world rate of return, essentially. And what's the relevant tax rate? What's the relevant personal tax rate? If we think about tax rates on dividends, for example, what's the relevant personal tax rate for those companies in the UK? Well, it's not just UK tax. UK companies can be owned by anyone in the world and are. And at the margin, they could be owned by anybody. So the relevant personal tax rates could be anybody's. It's actually likely to be a kind of an average of everybody's tax rate in the world who might be investing in that company. What does that imply? It implies that UK investment decisions by UK companies ought not to be affected by personal tax rates on UK individuals. There's a real divorce between what we expect investment decisions to depend on and personal taxes. And I think that's something that we economists have been thinking about and working on for several years. And I think we've certainly kind of developed our thinking. I think in this case, actually the tax system has developed as well. So a quick aside on the imputation system, which applied for kind of roughly half of the 50 years that we're looking at, from I think 73 to 99. So let's we think about that at the level of the company and the level of the individual. So companies paid ACT. They, if that was paid out of UK income, that could be set against UK corporation tax. But if it was paid out of foreign income, it couldn't be. So there's an additional tax surplus ACT, which was the source of much debate in the 80s and 90s. In effect, that was discriminating against outbound investment by UK companies. The tax credit was only available on dividends from UK companies. It wasn't available on from dividends from foreign companies. And that was distorting UK investment decisions or savings decisions by UK individuals. So kind of both elements of the imputation system was really creating distortions to decisions by UK savers and investors. So let me give you some evidence on this. So I would like to tie this into some of the research that we've done in the centre over the last few years. So one of the things we did was to kind of look at what the effects of the 1997 abolition of the repayable tax credit to zero-rated taxpayers in the UK, so like pension funds. So prior to 1997, pension funds received, for those who can't remember it that long ago, if they received a £1 cash dividend, they could go along to the Inland Revenue and get another 25 pence back. So every £1 of cash dividends was worth £1.25. Gordon Brown abolished that in the 1997 budget, so that actually, whereas a cash dividend had been of £1 had been worth £1.25, it is now worth £1.20. It's worth £1. That's a 20% reduction in the value of owning shares by UK pension funds. And UK pension funds were very big owners of UK equities at the time. They owned something like 30%, 40% of the market. So we might expect that to have had a pretty big impact on UK companies and on UK share prices, if we believe the kind of standard theory, but not if we believe the kind of theory that I've just kind of been promoting to you. So what happened, if you look at share prices at the time, and if you look at all kinds of measures of things based on share prices, you basically can't find any effect at all. This is a dramatic change in what should be the valuations of a very important group of shareholders. There's actually no impact on the share prices at all, consistent with the story I've just told you. What would we expect, though? Pension funds were essentially being given a subsidy to invest in UK equities rather than anything else, foreign equities, for example. After 1997, that subsidy was taken away. So, effectively what we might think is that prior to 1997, the kind of benefits of diversification from kind of owning shares around the world that UK pension funds might have had, and which were kind of, they were encouraged not to have because of that subsidy, was taken away. We might expect them then to have diversified more. So if we look at what happened to pension fund holdings after 1997, this is a picture back from 1979 to 2007 of direct holdings of UK equities and foreign equities by UK pension funds. You can see that, actually prior to 1997, UK pension funds held much more of their resources in UK equities rather than foreign equities. But after 1997, it started collapsing. And, by 2007, they were about equal. This is so what we've done is taken away a subsidy to investing in UK equities. Not surprisingly, pension funds have moved away from that. But the effect on the share prices, the effect on investment by UK companies has been, negligible. So that's kind of what I wanted to say about kind of the relationship, certainly at a kind of large company level, between corporation tax and personal taxes. I think we've really kind of developed our thinking on that. And I think actually we've got to a position now, having got rid of the imputation system, which just kind of makes more sense in some ways. So that's number one. I can't quite see the clock at the back, so I'll just keep going. So the next thing on my agenda was tax rates and tax base. Peter's already mentioned this. So here's a picture of what happened to the UK tax rate. It was 52% until the Lawson reforms in 1994, and it's come down slowly since then to 20%, as everyone knows. I thought I'd also put up a picture of the, one kind of pretty crude measure of the tax base, but this is the present value of capital allowances for plant and machinery and for industrial buildings. So this is, you write down, you think of all the allowances you're going to get over time, you discount that appropriately over time to get the net present value now. So this is quite an interesting picture because, both extremes are present in this picture. In the 1970s, if you invested in plant and machinery, you got 100% allowance up front, so you could, there's an immediate expensing of plant and machinery. The other extreme is now with industrial buildings where the rate is zero. So we've seen everything between 0 and 100%, over the last 50 years for different kinds of assets. And clearly, certainly since the mid-80s, the generosity of these allowances has been diminished quite a lot and quite deliberately. So, and the starting point, or the kind of most significant point, was really the 1984 reforms with Nigel Lawson, where it reduced the tax rate from 52% to 35% over a couple of years, and dramatically reduced capital allowances. So I think a rationale for that was the tax rate's too high. What we need is a kind of broad base and low rate tax system. So just as an aside on that, one can always kind of reduce the tax rates and broaden the base by, just not allowing costs. Industrial buildings is one example. We could make the tax base as wide as we like. We could say all capital allowances go to zero. If you want to make it still broader, we can say, you can't deduct wage income either. There's lots of ways in which you get the tax rate down, but we won't have a tax on profit anymore. And indeed, I'd argue in some senses we don't have a tax on profit now. So I think there's certainly limits to how we should think about a broad base and low rate. I think the idea of a low rate does come from economic theory. If you go back to kind of theoretical models, then the social cost of the distortions which are kind of arising from tax rates, in theoretical models that can be proportional to the square of the tax rate. So if you have a high tax rate and you square it, you get a very big social cost. And if you can reduce that tax rate by having a broader base, that will actually reduce your deadweight cost. But how do we apply that in corporation tax? I think that's normally applied, and people think about that as saying, yes, it's good that the statutory tax rate is lower and we have to pay for that with having a broader tax base. But then we really need to think more about what are the margins that are actually important here. What marginal tax rate are we actually thinking about? And the Lawson reforms went directly against what had been proposed by the Mead Committee in 1978, which was that actually there should be expensing of investment with 100% capital allowances. Such a tax rate, in principle, the cash flow tax that the Mead Committee was proposing would just fall on economic rent. It's going in pretty much the exact opposite direction of the Lawson reforms. So we need to think about, what are the margins that are important when we're thinking about companies. And the margin that certainly the Mead Committee was thinking about, and much economic research in the 80s and the 90s was thinking about, was the effective marginal tax rate. And the idea here is, we think in terms of the cost of capital on a new investment. So what's the cost of capital is the kind of break-even rate of return. What's the required rate of return on this investment in order to break even? And then we think of the tax rate as saying, well, how does the tax system affect that cost of capital? So the effective marginal tax rate is really the proportional change in the cost of capital arising from the tax system. So if we increase the cost of capital, we're going to get less investment in the UK. Under a tax on economic rent, the effective marginal tax rate goes to zero. So with that kind of margin, which is really the one that the Mead Committee had in mind, again, John can correct me because John was a member of the Mead Committee, but that would have given us a zero tax rate on this margin. It wouldn't have affected investment decisions under that kind of thinking. So the 1984 reforms kind of went the other direction. And, this is a kind of broad picture of what happened. The statutory tax rate fell. That's fine. That's what we know, 52% to 35%. The effective marginal tax rate went dramatically in the other direction. Now, it's a bit odd if you look at this, because the effective marginal tax rate, certainly in the way that we typically measure it, was large and negative before the Lawson reforms, and it became positive after the Lawson reforms. The reason why it's large and negative before the reforms is that not only, this is just for plant and machinery investment, but some of that is financed by debt. And so if you have the combination of immediate expensing of plant and machinery investment, but also interest deductibility, then then you have a tax which is on something which is smaller than economic rent. And that's probably too much of an encouragement to investment. But certainly the effect of the laws and reforms were on this margin, at least, when we're thinking about investment, to have gone precisely the opposite direction of what happened to the statutory rate. So that's certainly what we were thinking about in the 1980s and most of the 1990s. But in the 1990s, I think we began to think much more about international issues. And two important effects of that, I think, are one, that before that we were thinking of kind of companies making marginal investment decisions and even international decisions depending on that. And then we began to think much more in kind of discrete choices. So a company may make a decision to kind of set up a factory in France or a factory in the UK, but wouldn't do both. Now actually, the margin there is actually rather different from the margin that I've just been talking about. There, what matters is how much of your profit will be taken away if you go to France, how much of your profit will be taken away if you go to the UK, and we should compare those two. And that's really a comparison about effective average tax rates. And quite a bit of the research I was doing in the 1990s was about kind of trying to develop measures of the effective average tax rate and see how that affects real location decisions by companies. The effective average tax rate, again, depends on both the tax rate and the tax base, but in a very different way from the effective marginal tax rate. And the other thing that we're worrying about then and worrying about even more now is base erosion and profit shifting. That actually does depend much more on the statutory tax rate rather than these effective tax rates. And what I have in mind is any company might as well use up all the allowances, all the costs that's allowed to in any particular country. What it's actually shifting around is taxable income, and the relevant marginal tax rate for that is the statutory rate. So that means the life is much more complicated now than we thought it was, back in the early 1980s. There's at least those three different things that we should worry about: the statutory rate, the effective average tax rate, and the effective marginal tax rate. So here's a quick picture of what the coalition did since the coalition came into power and said we want the most competitive tax regime in the G20. Over the last few years, we've kind of been measuring how they've done with that aim. The one which the government likes to point to primarily is what's happened to the statutory rate. As you know, it's come down to 20%. We're now equal top in the G20, or equal bottom, depending on which way you look at it. But we certainly there is no other G20 country with a lower tax rate. If you look at the net present value of allowances, and this is kind of an average across kind of different investment in different kinds of assets, we've actually gone the other direction. We were 17th in the G20, and we've moved to 19th. Quick quiz question: how many countries are there in the G20? There's 19, so actually we're bottom. So one of them is the European Commission. That doesn't really count here. So we're top on the tax rate and bottom on the allowances, or the other way around, depending on how you look at it again. So we've gone up in the table in both the EATR and the EMTR. But we're on the EMTR. The effective marginal tax rate depends much more on the definition of the tax base, and that's why we look much worse on the effective marginal tax rate than the effective average tax rate. So there's some way to go if the new government really wants to continue that aim of having the most competitive tax system, which is a questionable aim, but if it does, it's got a little way to go yet. Okay, number 3, and I'll be slightly more quicker on these sources of finance. My first point here is there's been less development of views, in the sense that when I first started at IFS, I was told that actually there shouldn't be any discrimination between debt finance and equity finance, and I think that's what we still think. As economists, we still think. So I think our development of kind of thinking about this hasn't really changed very much. And I think where have we got? There have been changes in the in the domestic and the international tax system on this over time. Why do we have the system that we have? And I think this comes back to what Peter was saying earlier about if corporation tax is a proxy for personal income tax, then perhaps we might think of it as what it's really trying to do is tax the bit that's more difficult to tax at the personal level, which are retained earnings. So if you own shares in a large company, then it might be easier to tax those retained earnings at the level of the company than to allocate that to all the shareholders. In that context, then perhaps the interest could be taxed in the hands of the the lenders rather than at the level of the company. But the same would be true of dividends. We can easily tax dividends at the hands of the in the hands of the shareholders, which raises the question of why we need to tax all of corporate profits. Why we also don't have a deduction for dividends if that was the kind of basis for the tax. But in any case, everybody here knows the history of debt versus equity. I think clearly the issue is more serious at an international level than it was when we were just thinking about it at an individual country level. So there have been many proposals for reform put forward over the last 50 years. The Mead Committee had a proposal actually two proposals, one for a cash flow tax just on real flows, which ignored financial flows altogether, and one for what it called the R plus F base, real plus financial, where financial flows would be taxed as well, in a sense. So both of those would be taxes on economic rent, but one would just be on profits attributed to real flows, the other to real plus financial flows. There was a kind of modification of that proposed by the IFS Capital Taxes Group in 1991. I should mention here that several of the speakers today were actually members of the IFS Capital Taxes Group in 1991. It included John, of course, who's been on all the important committees. It was chaired by Malcolm Gammy, who's here and will be speaking later, and another member was Edward Troop, who is also speaking later. Actually, part of the plan of the IFS Capital Taxes Group was to infiltrate one of our members into government, to get into a senior position in government where he would be in a position to implement our proposals. So it's only a matter of time before we see that happening, I believe. So the idea of the ACE relief was very similar to the Mead Committee, but it just kind of the timing was different. The idea was we should treat equity in a similar way to debt by giving a kind of relief for the opportunity cost of finance. And in net present value terms, that's rather similar to a cash flow tax. In the same year, 1991, the US Treasury, I'm not sure proposed might be too strong, but they certainly issued a document exploring the possibility of going the other direction, of saying let's just get rid of interest deductibility and have a tax on the whole income of the company. I think what we actually have seen is rather arbitrary limits on interest deductibility. We have the worldwide debt cap, other countries have other kinds of restrictions, and the BEPS process at the moment is trying to figure out how we could effectively have what I think of as being arbitrary limits. And then I kind of come back to the principles. Do we want to give relief for interest payments or not? If we do, then why are we concerned if they're high? And if we're concerned they're high, isn't that actually suggesting to us that we don't really want to give relief for interest in the first place? So any arbitrary limit says, okay, well, anything up to half your profit is okay, but above half your profit is not okay. Seems to me to be extremely arbitrary, and I can't think of any good reason why one would want a tax system like that. Some more advertisement of CBT research. There's going to be a lot of this today, I'm afraid. So a project I did with Ruud de Moy, who was visiting here at one point, was actually to kind of try and figure out what the economic effects would be of moving either to an ACE system or to a CBT system, or what this kind of combined system was saying. That the ACE would say you get full relief on all costs of finance through either equity or debt. The CBT system says you don't get any relief at all. This combined system would say, okay, what we're going to do is to give relief for equity and debt, but only partial relief. So in a kind of revenue neutral way. So we're going to take away some of the interest deductibility and give that to equity in effect. So you might get relief for, say, 50% of your interest payments and 50% of an opportunity cost of equity, but in a revenue neutral way. So this is some evidence of what the effects would be of doing either of those. The problem with ACE is actually we're taking away a big chunk of the tax base, and you need to increase the tax rate. And this was kind of an average effect across many European countries at a time when tax rates were rather higher. But that was, and our central estimate was that tax rates would have to rise on average by 17 percentage points to be revenue neutral. So that's quite a big increase in statutory tax rates. The benefit of moving to CBT was that we're broadening the tax base again. I think Nigel Lawson might have approved even. We'd be able to reduce average tax rates by 11 percentage points, and the combined one was designed to be revenue neutral, so the tax rates wouldn't need to be changed. Both of these would, because they're equalising the tax treatment of debt and equity, would reduce the proportion of debt used by companies, and they both stimulate the economy. The ACE system would stimulate the economy by having a tax on economic rent only, and that reduces the cost of capital. There'd be more investment. That would increase the demand for labour, push up wages, and push up GDP. CBT would do the same, but kind of primarily by just having a much lower tax rate, and that would kind of increase investment into this economy to some extent at the expense of other economies. So that's kind of a bit more, because of our economy. If we introduce a CBT at a much lower rate, that would increase in investment here at the expense of some other economies. But these numbers are, 0.81% of GDP may not look big, but those are quite big numbers, just for a kind of relatively modest reform in one particular tax. Okay, finally, the last thing I wanted to talk about was international issues. And this is the kind of most complicated of all, as we're still clearly struggling with these things. And here we go back at least to the 1920s, so well beyond the 1965 introduction of corporation tax. And this kind of 1920s compromise, which said we should tax active income on a source basis and passive income on a residence basis. So we now need to decide, whether income is passive or active, whether it's a royalty or interest or so on. There's been lots of reforms in the UK trying to implement these kind of ideas. As Peter mentioned, introducing CFCs, transfer pricing rules. In 2009 we changed the taxation of dividends. On top of that, there's clearly been things that are happening in the UK because of what's been happening in the EU. Malcolm is going to be talking about that in much more detail this afternoon, but we have a parent subsidiary directive, we have interest and royalty directive, and we have kind of many European court judgments. And on top of that, we now have BEPS. So I'm going to say one thing about BEPS at this point, which is the basic principle that BEPS seems to be wanting to use is that there should be tax in the location of the place of economic substance. Now, that may seem like a kind of reasonable thing to do, to tax where economic substance is. It's quite a long way from where we might have started when we were thinking about corporation tax, if what we were really trying to do was to tax the income of individuals on their worldwide income. But let's go with that. And my main problem with that is it's not the same as what we started off with in the 1920s. If we want to tax passive income on a residence basis, that's not the same as saying we want to tax where economic substance is. The residence basis says we're going to tax passive income where this income is owned. And if I lend to somebody else in a different country and I receive income here, I'm taxed on it here. I may not have any economic substance here other than a contract which says you owe me some money, or I may own an intangible asset here and receive a royalty. That's what the existing international tax system is based on. That's not necessarily requiring economic substance. So if we require economic substance, then perhaps we should go in that direction. We should kind of question where we're starting off from. We should say, okay, well, maybe the principles we've got at the moment aren't working too well. Let's think of a new one. That would be a reasonable way forward. But to say they're not working very well, so let's overlay a completely different principle on top and actually pretend it's part of the same system, it just kind of leaves the principles completely confused as far as I can see. Nevertheless, that seems to be the direction which we're going. So what problems do we have? The problems are well known. Corporation taxes probably kind of creates more real economic distortions than any other taxes. There's certainly economic analysis and literature to support that. It's harmful for economic growth. It affects the location of economic activity. It affects investment decisions, and it affects everything else that corporations do. And those cause real economic costs and real economic distortions. So, okay, one more piece of research that we've done in the centre recently is to try and measure what those social costs are. Admittedly, it wasn't kind of directly about international aspects, but we were trying to measure social costs. And one of our measures says that for every pound collected in tax revenue, there's 29 pence of social cost due to distortions, in investment location decisions and the rest of it. So it's going to cost a company or going to cost one society £1.29 for every £1 that's actually collected in corporation tax revenues. These are quite big numbers. So that's one part of the problem. The other part is, as we all know and love, is base erosion and profit shifting. Among other things, that clearly undermines trust in the tax system, or public trust in the tax system. Is every day you pick up a newspaper and say another multinational company isn't paying their tax, then individuals begin to wonder whether they should be paying their tax as well. So, where do we go from here? And there seems to be this kind of dichotomy. Are we collaborating? Are we trying to cooperate with other people, other countries to have a sensible tax system, or are we competing with them? Or are we doing them? Are we doing both simultaneously? Well, the coalition government obviously was, rather competitive. It wanted to have the lowest tax rates or the most competitive tax rates in the G20. On the other hand, it's been, it's playing a big role in the BEPS process. If David Gauke was here, I'm sure he would defend this as being, perfectly reasonable. That we're competitive when we're engaging in fair tax competition, but we're against avoidance. It's not clear to me that we can really make such a fine distinction here. We can compete on all kinds of aspects of the tax system, and we do. One thing which the Treasury proudly announced at one point was we have a very generous treatment of interest deductibility, and that creates a competitive advantage for the UK. That's kind of certainly gets to some of the things which the BEPS process is trying to deal with. So there are kind of short-term and long-term issues here. Should certainly, there may be a short-term and a benefit for the UK in having a 20% tax rate. Now, how long will it be before that short-term gain evaporates because other countries are going to follow suit? I don't know how long it will be, but my guess is that that will happen at some point. Potential reforms here. Well, the BEPS process, may change things, depending on where we get to. But it's essentially kind of taking the existing system with, as I say, and possibly an extra principle, closing loopholes. We have the CCCTB or the CCTB. And apparently the Commission thinks by dropping the C and just having the common tax base, we're going a step-by-step approach, which is useful, but I hope I'm around in 50 years' time to see the kind of next step when we actually move to consolidation. Again, in the centre, we've kind of been thinking of other things that one could do, either moving to a kind of pure residence basis, which I think might be where we started, or moving in the opposite direction of a destination base and actually thinking about whether we can actually tax profits in the place of where consumers make purchases, which is kind of maybe kind of more easily identifiable and less mobile than the existing systems. But in all of these cases, I think one important question is will the system be undermined by competition? And the problem with the source-based system that we broadly have at the moment is there's an incentive for governments like the UK government to reduce the tax rate and attract inward investment and to prevent profit shifting. So as long as we kind of keep with that kind of system, and there's those competitive pressures will always be there. So I think a long-run system, if we are going to tax corporate profits at all, a long-run system has to be what economists call incentive compatible. It's got to be the sense that that there's no incentive for an individual country to kind of move away from that or trying to undermine the consensus. And we're clearly, a very long way away from that at the moment, I think. So finally, where are we now? Just on these 4 headings. The relationship with personal taxes, where it's not perfect, but it's certainly better than it has been in the past. So not doing too badly. The tax rate and the tax base, we could do better. I think, we're pretty extreme. We have the lowest tax rate, but the kind of broadest tax base. I think that we do have a problem with the tax base there. We could do better. Treatment of different financial instruments, again, we could do better. That hasn't really changed that much. And the allocation of profits between countries, I think we could do much better. But it's a difficult problem and it will take us a long time. Thank you.